Today was one of those days on Wall Street where the headlines tell one story, but the details tell another. At first glance, it looks like a sharp sell-off. The Dow Jones dropped more than 450 points. The S&P 500 pulled back from record highs, and energy stocks suddenly lost momentum. But when you slow things down, when you zoom out, you realize this wasn't panic. This was a market catching its breath. By the closing bell, the numbers were clear. The Dow Jones Industrial Average fell 466 points, a drop of nearly 1%, closing just under 49,000. The S&P 500 slipped 0.34%, ending the day around 6,920, pulling back after touching fresh all-time highs earlier in the session. Meanwhile, the Nasdaq Composite managed to finish slightly higher, gaining 0.16%. That split alone tells you something important. This was not a broad market collapse. This was rotation. Money didn't disappear. It moved. Coming into this week, the market was hot. Both the Dow and the S&P 500 had just set new record highs. Financials and energy stocks were leading the charge. Momentum was strong, confidence was high, and optimism around the start of 2026 was clearly priced in. And when markets get stretched like that, it doesn't take panic to cause a pullback. Sometimes all it takes is profit-taking. Investors who bought earlier simply locked in gains. That selling pressure was enough to cool things off, especially in sectors that had already run hard. Two sectors stood out today for all the wrong reasons: financials and energy. Both were down more than 1%. Big-name bank stocks like JP Morgan, Bank of America, and Wells Fargo all finished lower. These stocks had been strong to start the year, so today's move looked less like fear and more like money rotating out after a solid run. Energy stocks told a similar story. Heavyweights like ExxonMobil, Chevron, and ConocoPhillips dragged the sector down, and this time there was a clear reason behind the weakness. Crude oil prices dropped again today, extending losses from earlier in the week. The catalyst was comments from President Donald Trump regarding Venezuela. Trump said interim authorities in Venezuela would be turning over as much as 50 million barrels of oil to the United States. That immediately raised concerns about increased global oil supply, and when supply expectations rise, prices usually fall. Market participants quickly adjusted. Oil prices slipped, energy stocks followed. One portfolio manager summed it up clearly, saying the lack of sharp movement in oil prices suggests the market still believes supply is far from tight. In other words, no shortage panic, no supply shock, just oversupply risk. Earlier this week, markets had already digested news of U.S. military action involving Venezuela. By today, that concern had largely faded. Investors didn't see the situation as something that materially changes U.S. economic growth prospects. Equities reflected that view. The takeaway from Wall Street was simple. Geopolitical risk is rising globally, but for now, it's not enough to derail the broader U.S. market trend. That doesn't mean the risks are gone. It just means they're not driving today's price action. Another pressure point today came from Washington. President Trump said he would not permit defense companies to issue dividends or conduct stock buybacks until concerns about production and maintenance are addressed. Those comments hit defense stocks immediately. Shares of Northrop Grumman, General Dynamics, and Lockheed Martin all moved lower. The Aerospace of Defense ETF also slipped. Markets don't like uncertainty, especially when it comes from policy, and today, defense stocks paid the price. Trump also announced plans to ban large institutional investors from buying single-family homes. That policy move weighed on private equity names like Blackstone and Apollo Global Management. The logic behind the move was political and social, aiming to protect affordability for everyday Americans. But the market response was immediate. Stocks tied to large-scale real estate ownership moved lower as investors reassessed future growth in that space. Interestingly, while energy producers struggled, oil refiners told a different story. Shares of Valero Energy and Marathon Petroleum gained ground after reports suggested Venezuelan oil sales would continue indefinitely and sanctions could be reduced. Lower crude oil prices can actually benefit refiners by improving margins, and today, that dynamic showed up clearly. This divergence inside the energy sector is another sign that today's market wasn't chaotic, it was selective. While the Dow and S&P 500 pulled back, the Nasdaq quietly held up. That suggests continued interest in growth, technology, and innovation-related names. Semiconductors, artificial intelligence exposure, and select software stocks remained on investors' radar. Even as broader indices cooled, tech demand didn't disappear. This split reinforces a key theme of 2026 so far. Money is rotating, not retreating. Beyond headlines, several economic data points were also in play. Service sector activity rose in December, hitting its highest level of the year. Job openings declined, but the labor market remained relatively stable. Private payroll growth turned positive again. None of these reports screamed recession. None of them suggested runaway inflation either. Instead, they painted a picture of an economy slowing slightly, but still expanding, and markets generally prefer that balance. Gold pulled back today after a massive run in 2025. Profit-taking appeared to be the dominant force there as well. Oil continued to slide on supply expectations, but again, there was no sign of panic selling. Safe havens didn't surge, risk assets didn't collapse. That balance tells you something important about investor psychology right now. Today's market action wasn't a warning siren, it wasn't a breakdown, and it wasn't a trend reversal. It was a reset. After record highs, markets often pause. They digest gains, they rotate leadership, they test conviction. That's exactly what happened today. Zoom out, and the bigger picture becomes clear. The US market is still near all-time highs. Economic growth hasn't collapsed, corporate earnings expectations remain intact, and liquidity hasn't vanished. At the same time, geopolitical risks are rising, policy uncertainty is real, and sector leadership is shifting. That combination creates volatility, not chaos. So to wrap it all up, the Dow dropped more than 450 points. The S&P 500 pulled back from record highs. Energy and financials cooled off. Tech held steady, and investors continued rotating rather than rushing for the exits. This was a market taking a step back, not falling apart. That's your complete US stock market breakdown for today. For clear, simple, no-hype market analysis, you're watching Streetex News. Thanks for staying with us, and we'll see you in the next update.